One thing I can promise you, even in this market, is that I never ask my clients to judge me on my winners. I ask them to judge me on my losers because I have so few. Hi, I'm Josh Lipton. That was the line from Wolf of Wall Street, Jordan Belfort. Amazing movie, love it. And that line recently came to mind after watching a Tom Nash YouTube video where Tom went over his losers. I thought it was a great video and a great exercise. In fact, in sales meetings, I used to try to share a loss because everyone thinks everyone's always winning. We would always share our wins, and it gives a false perception of some weeks in sales are bad. And same with stocks. You know what? You're gonna have some great winners. You're gonna hit a Tesla, but you're also gonna have ones that just don't work out in the end. Even Buffett, the best. No one's shooting 100%. We're going for baseball. We're trying to hit a good average. So I thought today I'd go over some of my losers and kind of discuss what I learned from them. Because to me, it's never a real loss if you can learn something from it that helps you make more money and make better decisions in the future. So here is my loser portfolio, and I'll go over them one by one. So the first section here is called tips. These are companies I did not research at all. I heard something on a podcast online from a friend and just bought the stock. And that's the biggest lesson I learned is do your own research. So these were just tips. I just listened. This first one, Best, was a logistics company in China. Got hit super hard, down 50% from when I bought it. It's probably down even more. API was a company that it's called Agora that was rumored to be the backbone. It does audio APIs for Clubhouse. When Clubhouse was hot, shot up, and it's down obviously a ton, 73%. Root is a car insurance company. I heard some good things. Went straight down. It was like a car insurance app. SNN. This is the worst. I was making a ton of money in cannabis when it became legal in Canada and making money hand over fist. Couldn't stop making money. So a friend said, oh, you should check out this one, SNN. The second I bought it, they got hit with a lawsuit and basically filed for bankruptcy. You see 97.8% down. And Real is a Canadian company that, again, I just heard a tip about. I don't even remember much about it, but you can see huge losses. These are massive. And these were tips, and that's what I learned. Do your own research. Maybe take a tip and use that as a screener, but you should still do your own research, and I didn't. I just heard someone say this looks good and bought it. So those are some of my losses. Next one I have is called Stupid or Just Out Over My Skis. I just didn't understand this. These are complex financial vehicles. There's actually another one here, but I can't even find it. It was another warrant. So this is Open W, so this is Open Door, which I believed in the company, but I bought the warrants because I thought, oh, I'll be leveraged and I'll get a little bit more money. Anyway, they recalled the warrants and I didn't exercise them in time and lost the entire value. So down the drain. Again, good investment, but I didn't understand really what I was doing. And same with CRM. I bought a while back some Salesforce options and I made a ton of money leading up to the earnings. It was up double. And I thought, oh, just wait until after the earnings date. I'll sell it after. I'll do even better. Nope, earnings disappointed. And the thing shot down 87.2%. I sold. Again, just didn't fully understand the complexity of these financial instruments. So that was number two. Really make sure you're understanding what you're doing. Yeah, leverage can be good, but sometimes simpler is better. I'm a big believer in that. So don't start with options and stuff like that. It can be very complex, and don't get into anything unless you really understand it. And the last group of losses is what I just call process losses. These were just investments I made where my mindset was not great going into it. So the first one, ABX, is a gold mining company, and I just, you know what? It's good to have 3% of my portfolio as a hedge in gold. And I thought, there's money printing, it'll go up. And I thought it would be a great investment, and it was down 30% when I sold it. And thankfully, I also had a bunch of Bitcoin. Those were my two portfolio hedges, and gold did terrible, down 30%, but Bitcoin probably tripled during that. And I already had Bitcoin before that. And so that it ended up working out. It is a hedge. You're going to have some losers, but you're trying to make sure your entire portfolio works. So it was just a bad process saying, maybe I should have done a little more research into gold. I don't really understand the industry. I also had McDonald's. I figured that they're going franchise heavy, which is a very capital light business, and I thought that was great, but I didn't really do the valuation, and it was very fully priced. So a great company again, but I didn't do my own valuation. And NRZ it's a REIT that holds mortgages, and when COVID hit, rates plummeted. I thought, oh, rates are at 3% or whatever. How could they go any lower? Obviously they did, and that trend's continued. So I kind of just, again, didn't do my valuation, didn't look at the downside. And the last one, EAGB, which is actually an ARC investment, but it's the Canadian holding for an ARC investment. It's the genomics one. And again, I'll give a shout out to Justin O. He told me this. I was like, oh, I believe genomics and bioengineering and biotech is going to be huge in the next 10 years, and I still do. But he said, why would you buy ARC-G if ARC-K is the best of all ideas? Why would you buy one that's just genomics? Yeah, you're getting exposure to space, but is that the best risk-adjusted return? Which is really what we're going for, is risk-adjusted return. So I sold out of that and put it into some other better investments. But again, I just didn't think, I thought, oh, this is an industry that's going to grow. It's not enough to do that. Is the valuation fair? So that's kind of what I learned. One, don't just listen to some random person on the street or you're, on Reddit. Do your own research. Two, make sure you understand the financial vehicles you're buying. Don't get too fancy and complex. Just buy the stocks typically straight up. I've done very well doing that. Or if you do, make sure you understand the risks involved with the warrants or options. And three, make sure you actually do the valuation and look how it fits within your portfolio. So these are some of my losses. You can see some huge negatives here. Thankfully, my portfolio's done very well despite those because I did kind of learn a process that I've been working on that's worked very well for me. But I wanted to share my losses. So shout out to Tom Nash. Thank you for the inspiration for this video.